and good day everyone. So I'm Aury Ganadin from FTM44. So I'll be discussing about the to-go group and subsidiaries. First, our objective is to study the company's profitability. So let's know about more the to-go group incorporated. To-go group incorporated is a Philippine-based company engaged in transporting people and cargo. So it is under the service industry. Its former ATS or Avoidis Transport System that owns Super Ferry, Cebu Ferries, Supercut, and Negros Navigation. To-go embodies a leadership and service built on 148 years of shipping and logistics experience. Today, To-go Group Inc. is the largest premier logistics provider in the country. So, we are going now to our analysis. Presented here is our statement of financial position or the balance sheet and our income statement over here, the consolidated statements of income. So for our analysis, we are going to use the profitability ratios. First is the gross profit margin. So gross profit margin is gross profit over revenue. So in order to get our ratio, we will be using for 2010, we will be using our revenue, our 11,610,892 over the gross profit, which is revenue less the cost of goods sold, which is 2,206,641 all over the revenue. So we obtain, by dividing the gross profit over revenue, we got a result of 81% for 2010, 80% for 2011, and 86% for 2012. So in 3 years, we have an average of 82.3, which exceeds the industry average of 14% for logistics and service industry, meaning to-go generates a level of service that enables them to pay for operating expenses and profit. So next is the net profit margin. So our net profit margin is net income over revenue. For 2010, our net income or loss is 755,375 over our revenue, which is the 11,610,892. So it shows net profit margin shows the proportion of every peso sales that is left after all expenses have been paid and remains as profit. It shows that a company is not keeping operating expenses under control to leave an acceptable profit industry average of 2%. So it means it is unfavorable. So next is our operating profit margin. In order to get our operating profit margin, we have the earnings before income tax. So earnings before income tax of To-go Group Inc. is 1,535,891 over the revenue of 11,610,892. So our operating profit margin are all unfavorable, meaning with the industry average of 0.75, the results are unacceptable. Because this is the company has not enough return on sales to generate profit. Next is our return on assets. Our return on assets is the net income over average total assets. For 2010, our net income is 755,375, or else it is our net loss for To-go. And our average total assets for 2010, in order to obtain that, we need to get the total assets for the year 2010 and plus the total assets of 2009 divided by 2. So we get a negative 0.07, negative 0.05, and negative assets. Lastly, our return on equity. So, net income over the shareholders' equity. So, our net loss, 755,375 over the shareholders' equity for 2010 is 3,942,399. So, just like the other ratios, we obtain negative results due to net losses. So, this ratio means that due to expenses, there is no enough profit generated from the shareholders' investment. Remember that although we have a very high revenue, but also a very high expenses, it will result into a very low profit or else no profit. So for our findings, our gross margin shows that the company still earns, taking into considerations the cost that it incurs. So unfavorable results for net profit margin, and the company is not converting the revenue into profits available for shareholders, just like what I said earlier, that due to increased expenses, we have in the notes in their annual report that through 2010 they have their pre-integration period, meaning that they are acquiring the shares of their subsidiaries, which is the Negros Navigation. That's why they have increased or they have incurred such high expenses. So the company doesn't utilize well the use of its assets because of the net losses. Then for the statement of the problem, company's profitability is deteriorating. So because of increased costs and expenses, then for our conclusion, To Go Group Incorporated suffered from losses due to their pre-integration phase.